The crypto derivatives market has grown to dwarf spot trading in volume terms, a structural parallel with traditional financial markets where derivatives represent multiples of the underlying spot market. This reflects the maturation of a market where institutions use derivatives for hedging downside risk, expressing directional views with capital efficiency, generating yield through options writing, and arbitraging price discrepancies across venues. For institutional participants, the crypto derivatives landscape is bifurcated. On one side sits the CME Group, offering regulated, cash-settled Bitcoin and Ethereum futures and options under CFTC oversight, the venue of choice for US-regulated institutions. On the other side sits the offshore perpetual swap market, dominated by Binance, Bybit, and OKX, where leverage ratios reach 100x, funding rates create complex carry dynamics, and volumes dwarf the CME by an order of magnitude. Navigating this landscape requires understanding the mechanics of each instrument type, the regulatory implications of venue selection, and the risk management frameworks appropriate for each. This analysis provides the institutional toolkit. The three core derivative instruments in crypto serve fundamentally different institutional purposes. CME futures are the entry point for US-regulated institutions. Standardized contracts, daily mark-to-market, margined in USD, and settled in cash. No digital asset custody is required. The CME Bitcoin futures contract, launched in December 2017, was the catalyst for the first wave of serious institutional engagement with crypto markets. Perpetual swaps are the dominant instrument by volume globally, and their mechanics are unique to crypto. Unlike futures that expire, perpetuals continue indefinitely. A funding rate mechanism, paid every 8 hours between long and short participants, keeps the perpetual price anchored to spot. When the market is heavily long, funding rates become significantly positive, creating a carry cost for leveraged long positions that can erode returns during sideways markets. Options markets in crypto have matured dramatically since 2020, with Deribit emerging as the dominant institutional venue for BTC and ETH options. Institutional applications include covered call strategies to generate yield on existing BTC holdings, protective puts for portfolio hedging, and volatility arbitrage between implied and realized volatility. Funding rates are the mechanism that makes perpetual swaps work, and understanding them is essential for any institutional desk active in the offshore derivatives market. During the bull market phases of 2020 to 2021, annualized funding rates on major perpetual venues exceeded 100% for extended periods, meaning that maintaining a leveraged long position cost more than 100% per year in carry alone, even before considering price risk. For institutions, the funding rate creates systematic trading opportunities. Basis trading, simultaneously buying spot BTC and shorting perpetuals, captures the funding rate as a yield without directional price exposure. When annualized funding rates are elevated above 20 to 30%, this becomes an attractive relative value trade with defined risk characteristics. Delta-neutral funds running this strategy contributed significantly to open interest growth during the 2021 bull market. The risk in basis trading is twofold. The perpetual price can diverge significantly from spot during high volatility events requiring margin management, and the offshore venue credit risk is substantial and unregulated. The FTX collapse provided a catastrophic illustration of what happens when basis traders concentrate their short-side exposure at a single exchange with undisclosed solvency problems. The divergence between CME and offshore derivatives open interest tells the story of institutional adoption in crypto. CME open interest, dominated by US-regulated participants including hedge funds, asset managers, and proprietary trading firms, has grown steadily but remains a fraction of offshore perpetual markets. This gap reflects both regulatory constraints on US institutions and the superior product features of perpetual swaps for active traders. The spike and crash in offshore open interest around 2021 to 2022 correlates precisely with the bull market, the FTX collapse, and subsequent deleveraging. The recovery and new highs in 2024 reflect rebuilt institutional confidence, the launch of spot ETFs, and the maturation of offshore venue infrastructure post-FTX. For compliance officers, the open interest data has a practical application. Elevated open interest ratios between offshore and CME markets signal increased risk of sharp deleveraging events. When leveraged long positions are heavily concentrated in unregulated perpetual markets, the probability of a liquidation cascade is materially higher than baseline. Crypto derivatives carry risk factors that have no direct analogues in regulated traditional markets, and institutions entering this space frequently underestimate these risks. Liquidation cascade risk is particularly dangerous because it is endogenous. The market risk management mechanism of forced liquidation of over-leveraged positions amplifies the very volatility that triggered the liquidations in the first place. The FTX collapse is the canonical case study for exchange counterparty risk. Billions in derivatives positions were margined at FTX and became worthless overnight when the exchange halted withdrawals. No regulatory framework protected these positions, no deposit insurance covered the losses, and legal recourse has been years-long and only partially compensatory. For institutions that must use offshore venues, counterparty risk management requires active position limits by exchange, daily margin sweeps to cold storage, and continuous monitoring of exchange financial health indicators including proof of reserves disclosures and open interest dynamics. The basis trade is one of the most institutionally popular crypto-specific strategies, and its mechanics are straightforward. A fund simultaneously holds long spot Bitcoin and an equal notional short perpetual position. The price exposure nets to zero, meaning the fund has no directional Bitcoin risk. What it does have is exposure to the funding rate differential between longs and shorts in the perpetual market. During bull market conditions with elevated retail leveraged long positioning, funding rates can persist at annualized levels of 30 to 80% or higher, generating substantial yield on a delta-neutral basis. Several dedicated crypto hedge funds have been built entirely around this strategy, and family offices and endowments have allocated to it as an uncorrelated yield source. The strategy has three primary risks that every allocator must understand. Basis risk: the perpetual and spot prices can diverge significantly during stress events, creating temporary mark-to-market losses. Exchange counterparty risk: the short leg is held at an offshore exchange with no regulatory protection. And funding reversal risk: the strategy becomes loss-generating if funding turns negative for an extended period. Sizing must account for all three simultaneously. The crypto derivatives market has reached the scale and sophistication where institutional participation is no longer optional for funds with digital asset mandates. The ability to hedge, express views efficiently, and generate yield from existing positions is a competitive necessity. But institutional participation in crypto derivatives requires a distinct risk framework from traditional derivatives trading. The operational conclusion for most institutional desks is a tiered approach: CME futures and options for the regulated core of derivatives activity, with carefully managed offshore perpetual and options positions for strategies requiring additional liquidity and product range. The key is never allowing offshore exposure to exceed the loss capacity explicitly approved in the derivatives mandate. As regulatory frameworks for crypto derivatives mature, the CFTC has signaled increasing interest in bringing perpetual swaps under oversight. Desks that build derivatives capability now, with appropriate risk frameworks and institutional infrastructure, will be well positioned to capture the alpha that this still maturing market continues to offer.